Welcome to my channel. I'm going to show you step-by-step how to value a stock. Together, we will enter the company's financial information and capital structure into my Excel model. Then we determine whether the stock is a buy or a sell. At the end, we calculate and analyze the financial ratios. The company we're going to look at is Altra Industrial Motion. And this is a manufacturer of mechanical transmission products. Its products are used on industrial machines. So for example, the brakes on an elevator or forklift. Let's get started with the model. This company has a market cap of $2.7 billion. So that's the value of the company according to the stock market. And it's a mid-cap company. Mid-cap means its market cap is between $2 and $10 billion. They're trading at almost $42 a share. And the way you value a company is you estimate the future free cash flows and then discount that back to today's value. That's what we're doing in this video. Now I'm pulling the actual free cash flows. And this is cash flow from operations minus capital expenditures. And then I'm going to pull the net income, which is the profit and loss for the business. And that's on the income statement. We also need the revenue, which are the sales for each year. That's also on the income statement. And the sales more than doubled from 2016 at $700 million to $1.8 billion in 2019. So everything looks pretty good so far, so we should get a good value for the company. Let's look at a capital structure. The interest they pay on their debt is $74 million. That's on the income statement. We'll go to the balance sheet to see how much debt they have. Go to the liability section. Current debt of $18 million, that's debt due within 12 months. Long-term debt of $1.6 billion, that's debt due after 12 months. Interest payments on debt are tax deductible, so let's get their effective tax rate. Income before tax $148 million. Income tax of $21 million. So their effective tax rate is 14%. The cost of debt is 4%. That's the interest rate, 4.7%, times 1 minus the effective tax rate. To get the cost of equity, we need the beta. That's how volatile the stock is relative to the market. Let's see what the beta is. It's 2.53, so it's a pretty volatile stock. It moves 2.5 times the market. That means it tends to be more risky. Let's go back to the balance sheet, get the current assets. Current assets is used to calculate the current ratio. Current ratio is current assets over current liabilities. So the current assets is $667 million, and that's $167 million of cash, $243 million in net receivables, and $222 million of inventory. Let's get their current liabilities. That's $339 million. Let's see what that's made up of. Current debt of $18 million, accounts payable of $154 million, taxes payable of $13 million, that's how much of taxes they owe the government within the next 12 months. Accrued liabilities $140 million, these are expenses that it accrued but has not yet paid. Let's look at our equity, that's $1.9 billion. Equity is total assets minus total liabilities. That's the value of the company according to the balance sheet. That's $100,000 of common stock, $315 million of retained earnings. And retained earnings are the earnings that's left over after a company pays its dividends. So it's the money it has to grow its business or pay down its debt. This means it's operating profitably. Accumulated other comprehensive income of negative $90 million. These are unrealized losses on some of its securities. Unrealized means it has not sold those securities yet, so it has not realized the loss. Let's go back to the income statement and get their operating income. That's $238 million. That's how much money it makes on its operational business. Let's look at a capital structure. 45% debt, cost of debt is 4%. 55% equity, cost of equity is 22%. WACC is 13.7%, which is a blend of the cost of debt and cost of equity. And that's a discount rate we're going to apply to the future cash flows. So we estimated 4 years of future free cash flows. That's up here in blue. We also estimated a terminal value, which is all cash flows past year 4. We discounted those numbers back to today using the weighted average cost of capital. And we get a value of the company of $1.9 billion. We divide that by 65 million shares. get an intrinsic stock price of $30. It's trading at $42, so it's trading at a 38% premium. So it's a sell according to the model. Let's see what Simply Wall Street says. They're saying $39, so they're a lot higher than me. My model is a little more aggressive because I take into account how much debt a company has and I reduce their future cash flows based on the debt. So maybe that's why my number is lower than theirs. Looks like the stock was trading in the mid-50s a couple years ago, but it's been up and down. That's why there's such a high beta. Let's look at the financial ratios. They have a high PE, a good price to sales, and a good price to book. So PE is stock price over earnings per share. To calculate earnings per share, that's net income over shares outstanding. And I like to see below 15. They're at 21.2. This means investors are willing to pay $21 for $1 of earnings. Price to sales is stock price over sales per share. To calculate sales per share, that's revenue over shares outstanding. I like to see below 2.5. They're at 1.5. So investors are willing to pay $1.50 for $1 of sales. Price to book is stock price over book value per share. To calculate book value per share, that's equity over shares outstanding. I like to see below 3.5. They're at 1.4, so investors are willing to pay $1.40 for $1 book value. They have a good interest coverage ratio, a weak ROE, and a good current ratio. So current ratio is current assets over current liabilities, so that's good. They can cover their current debts and payables. ROE is net income over equity. And I like to see above 20%. They're at 7%, so they're not providing a good value to their equity holders. Interest coverage ratio is EBIT, which is the operating income, over interest expense. And that's 3.2, so they can cover their interest payments 3 times. That's good. The best way to look at ratios is to compare them to similar companies. I've done videos on Graco, Honeywell, and 3M, all in the same industry as Altra. And if Altra has a number in red, they're worse than the average. If they're in green, they're better than the average. So in terms of PE, they're a little worse than the average. Honeywell is best. They do have the best price to sales and price to book. The current ratio is fine. They're all above 1. ROE, they're by far the worst in ROE. Every company besides them is above 30%. They're only at 7%. And in terms of debt, they're about average. In market cap, they're by far the smallest company of the bunch. So when you invest in a smaller company and a high beta company, it tends to be more risky, but you could make more money, but you could lose more money. That's the risk. Let me know what you think of the video. Thanks for watching.